standard deviation, beta, tracking error. So let's start with these. Tracking errors sound bad. You just want it to be as low as possible, surely.
Especially in the case of ETFs versus index funds.
How does alpha come into this? Because there must be a reason you're taking on this beta in the first place, right?
Yeah.
Tracking error in turn then leads to the concept of tracking difference, right?
Firstly, yes, beta is sum. The other big point is that
So, Deepak, there are a couple of terms that I think every investor needs to know, and I wanted to run them by you and Vashisht. So, the first one is standard deviation, the second one is beta, the third is tracking error. So, let's start with these. Standard deviation.
scary term because it sounds like something devious, but it isn't actually. It's just the wiggliness of your returns overall. That means I don't have a straight line of returns. I don't have a guaranteed return every day like a fixed deposit, which basically goes up a little every day and then reaches wherever it is supposed to be. So if I took the average return on a daily basis and said, oh, every day is either slightly above the average or slightly below the average, how much is this slightly on average is the standard deviation in that sense. So a fixed deposit has no standard deviation, but a stock market investment that goes maybe 2% up one day, 1% down the other day, the average of all such daily returns over a year is 0.5%. So the 2% number is 1.5% above the average. The minus 1% is 1.5 below the average. So you kind of take all these numbers and observations and run the calculations, and you say, oh, if my standard deviation is high, that means some of my numbers are very far away from the average. That means I have had average only 1% returns, but someday was plus 10%, someday was minus 9%. Scary stuff. The plus 10% is nice, but minus 9% is scary. So you look at this and say, well, you know what, this is really wiggly versus this is not so wiggly. That is, I think, the concept of a standard deviation.
Okay. And standard deviation then immediately feeds into the concept of beta or beta if you're in the US, which means something else here entirely, but doesn't it?
Yes, it firstly, yes, beta is sum, and but the other big point is that beta is just saying in standard deviation, I look at the absoluteness of those returns. That means again zero. That means I was 0 plus 2%, 0 minus 2%. But what if I just simply said, listen, there is something that I'm comparing against, which is the index. The index moves up by, say, 1% on average per year, and the returns of that index. What is my return in comparison with that? If the index were to go up 1%, what potentially could my return be? The answer is if I am also plus 1%, my beta is 1. That means I'm 1x the index. If I am going up 1.5% every time the index goes up 1.5%, and similarly on the bottom, on the below, I will actually say I have a beta of 1.5. So the more beta I have, the higher I move away from that index. You want something with high beta on the upside because when markets go up, I want more than the market. But you're scared of high beta on the downside because you're like, oh, if the market falls 1%, I'm going to fall 1.5. If the market falls 10%, I'm going to fall 15. This sounds scary. So it's a little bit of, oh, high beta means I'm trying to get higher returns in the index, but I'm sacrificing something when the market falls. So I have to know that in advance. That's what the beta actually means.
Vashish, you had done some work on looking at high beta as a strategy, right? And how does alpha come into this? Because there must be a reason you're taking on this beta in the first place, right?
Yeah. So if you look at all factors, I think high beta is one of the worst performing factors. Nifty Indices has one called a high beta index. If you plot its performance versus the Nifty, you'll see it's done really, really poorly. So in any portfolio, most fund managers would try to avoid high beta stocks in them. Now, beta, if like Deepak was explaining, it's relative to something. So if you were to take a benchmark and a fund and take the daily returns, on the x-axis you put the benchmark's daily returns, on the y-axis you have the fund's daily returns, and you plot the scatter plot. You do a best fit line. The slope of that line is beta. And where there's a y-intercept, that's your alpha. So you want alpha, and the beta is in pursuit of the alpha. So if you want high alpha and you want low beta, you don't want very high beta with high alpha. I think that will work, depends on your risk appetite. But that's the way to understand these two things. Alpha will is why most active fund management exists. And these are all relative measures versus something.
In fact, I'll add another layer to this. I'll say that it's not always advisable to only look for low numbers, because you want high returns. So you want your, let us say, I'm consistently doing more 1% or 2% more than the index, but sometimes it's 0.5%, sometimes it's 1%, but I'm always above. I get penalized with a high standard deviation, simply because my average, my positions, even though they're doing better than the index all the time, I don't get the benefit of saying, oh, I always did better than the index, just by different percentages each day. So it's not necessarily true. And then beta is a comparison index, right? So you have an issue. I'll give you an analogy. Indian children by WHO or some kind of studies are considered to be stunted. Now I went in and said, what do you mean Indian children are stunted? Well, it's not. It doesn't sound like it's such a bad this thing. I found out it's a statistical problem. They've taken the average of a few countries as a reference benchmark in that sense. These are countries like Netherlands and a few other places where people are relatively taller. So that taller becomes your average. Indians, even adult males and adult females, are below that average on general, considerably below in case of women, a little below in case of men. So children are naturally going to be below averages, world averages in general. So that means Indian children are not stunted if you look at Indian averages, but it is stunted in respect to a few countries that you have used as a parameter, and therefore, your concept of whether you're stunted or not comes from what benchmark you took in the first place. So you choose the wrong benchmark or you choose the wrong this thing. So it can change the perception. So if I took Indian children with respect to, say, Southeast Asian children, we would not be stunted at all, and some other country might look stunted instead. So you have technicalities here.
Building on that analogy, if you bring it back to mutual funds, then when you're looking at these numbers, always look at them within the same category. So standard deviation in a liquid or a money market fund will look very different than standard deviations in, say, a flexi cap category. So in a liquid fund or a money market fund, an overnight fund, the standard deviation will be very low. The volatility will be very low. And same way in active equity funds, the standard deviation will look much higher, somewhere comparable or slightly higher than the benchmarks.
This leads me to my next point, tracking errors. So tracking errors sound bad. You just want it to be as low as possible, surely.
Yes, you want it in the case of index funds. Tracking error is nothing but the standard deviation, as we have explained it, of the daily returns of a fund versus its benchmark. So you were seeing that if the benchmark moves 1%, how much I going to move? If the tracking error is high, you may or may not move 1%. You may move a little lower, a little higher. This plays out especially in the case of ETFs versus index funds. ETFs, because of their nature of people are trading it in the market. It's not like you go and invest and buy it on an NAV. So a market maker has to exist. Somebody has to create the supply-demand mechanics. And what happens is ETFs may sometimes on very volatile days not reflect the price of the index. The index, I think, when we have these crashes, it sometimes falls 5%. The ETF is only down 2%. So if you were an ETF investor and trying to take advantage of that volatile day, saying, okay, now index is down 5%, it's an aberration, I should be investing, the ETF may be the wrong vehicle to do it because it may not be reflecting it correctly. So ETFs will, if you look at the ETF's traded prices and calculated tracking error, you may see it's higher. But what's reported usually is based on the NAV of the ETF, which is a much more smoother number.
Deepak, tracking error in turn then leads to the concept of tracking difference, right?
Yes. So the tracking difference is actually what I think would be more palatable to us, because the number of tracking error would be 0.15 is good, 0.25 is bad. And in our minds, we can't get around this stuff, right? So it's like they all sound like really small numbers. We don't care. We're supposed to get 15% a year. What difference does it make if I get a 0.1% here or there? but it isn't actually 0.1. It's a higher number, but it is reflected in a 0.15. Statistical nerdism here coming to play, which doesn't exist in most people's minds. So a best thing to say is, boss, how much did I beat the index by? You call that alpha at one level, saying today I got an alpha of 3%. That might be this thing. But if you look at an index fund is not supposed to have any alpha. It's supposed to have alpha of 0. But there is a difference between what the fund actually got versus what the index got. So that is the difference called a tracking difference. So in the sense, it's your alpha. It's usually supposed to be negative because index fund has fees that drags down the returns, a bunch of other factors as well. But the tracking difference is essentially what you got versus what your mutual fund got, or sorry, what you got as a mutual fund and versus what the index actually returned. This tracking difference is revealed again on a daily basis. So you can see the average tracking difference to see if this fund is doing something strangely good, strangely bad. Good is a positive tracking difference, bad is a negative tracking difference. But the higher the tracking difference is, even at the extremes, then you suddenly realize there's something wrong. There are funds with tracking differences of minus 0.8%, which means if the index gave 12, you're getting 11.2. This is actually quite bad, because 0.8 over a 10-year period adds up to a considerable real absolute amount. But I would say that you have a 0.05, 0.1, 0.2%. That is pretty much where the standard averages are.
So you will see these numbers change based on what index you are monitoring, because it depends on the index construction. If the index has high churn, for example, something that rebalances every quarter, and almost 50% of the portfolio changes, there's a lot of transactions happening, right? So each time you do transactions, you will incur some STT, something the fund will incur. The index is not incurring any of these costs. And then you have the realities of trading. So you may not be able to execute at the best possible price. So all of these will have an impact. And funds are real instruments where people are putting in money, redeeming money, and so on. So they have cash flows. So sometimes you may be left with some cash that you could not have invested on that day. So you'll have 1 or 2% cash sometimes, and that will add a cash drag as well. Same, a total returns index assumes that the day dividend has come, the same day it has been reinvested. While in real world, that is not the case. The stock may go ex-dividend, but the cash may come 2 weeks later. And then only you can reinvest it in the same fund. So those are reasons why tracking differences are by design. It's going to be there all the time. You can't avoid it. One note on tracking error versus tracking difference. A lot of people by default look at only tracking error. I think in passives, and we've done a video before with Deepak explaining on index funds that you should look at tracking difference. That's the main thing, because you could have an index fund that is consistently 1% worse than the benchmark, and it will have a tracking error of 0, but it will still have a tracking difference of 1%. So just be mindful of these two numbers and when to use which one.
Sharp is a measure of how well you do, and the higher is the better, right?
Classic formula would be a return of the instrument you have invested in minus the risk-free rate divided by the volatility.
Does this also mean that if you measure something less frequently, you will automatically have a better Sharp ratio because there's just fewer measurements?
Yeah, think of real estate, for example. If you have bought a house, you are not getting quoted a price on a daily basis.
PRC grade. Could you explain that to us?
So you rate these credit risks into 3 buckets: really good, sort of good, and everything else.
This grid sounds really nice. Is there an equivalent measure for stocks?
I wish there were.
There is a riskometer.
Okay.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Past performance may or may not be sustained in future and is not a guarantee of any future returns.